Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. Let me tell you what a perfect storm looks like for a predatory short hedge fund. You're leveraged to your eyeballs 60-1. The Fed Reserve, the Treasury, the government, even foreign governments are calling the SEC complaining about your leverage levels, especially when it comes to the basis trade. A huge chunk of your portfolio is trapped in short positions, and the market keeps rallying against you. Some of your positions are so large you couldn't cover them if you wanted to, and all you could do about it is buy calls to protect yourself. You have borrowed money up to the ceilings, and the best you can get from your prime bank is a $400 million bump on one of your term loans, and it's at a subprime interest rate. There are millions of people complaining about your tactics on Twitter round the clock and 24/7. You made your clients almost 20% returns on their investment in your fund, and to thank you, they are redeeming billions. And the worst part, all those politicians you paid off are looking at you like a virgin at an Incan sacrifice. If anything systemic goes down, they're going to sell you out like a $20 hooker. And now even Goldman Sachs alumni Gary Gensler is taking a pause from terrorizing the crypto market and is focusing on you and transparency. Here's your article. Let's kick it off. U.S. stock short sellers down $145 billion in 2023, according to Ortex. A late year surge in stocks is exacerbating the pain of short sellers who are on track for their worst collective annual loss since 2020, according to data and analytics company Ortex. Short sellers who aim to profit by selling borrowed shares and buying them back later at a lower price are down over $145 billion for the year, according to an Ortex analysis of short interest in 1,500 U.S. stocks. The losses have come in the face of a rally that has ramped up in the fourth quarter on expectations that the U.S. Fed Reserve is done raising interest rates and will likely pivot to cuts next year. The index is up 22.9% year to date and around 2% away from a record high. Okay, first let's talk about the Dow from Markets Insider. Mega cap tech leads U.S. stocks higher as the Dow Jones hits another record high. And more good news for the short hedgies. Let's chat about the S&P 500 from MarketWatch. It's not even the new year, and Goldman Sachs has already lifted its S&P 500 target. The ink barely dried on Goldman Sachs' S&P 500 forecast for next year before the Wall Street Bank decided it just wasn't bullish enough. Chief U.S. equity strategist David Kostin bumped to 5,100, the 4,700 target that was laid out just weeks ago, 8% upside from where the index stands currently. The S&P 500 SPX climbed 2.49% last week to close at 47.19, just 1.6% off its January 3rd, 2022 record high. Happy holidays, mother scratchers. And it's not a party without the NASDAQ, right? History says the NASDAQ will surge in 2024. There's no doubt that 2022 will go down in history as one of the toughest years on record for Wall Street, but markets appear to have turned the corner. After tumbling more than 35% in 2022, the NASDAQ Composite has rebounded with a vengeance, gaining 39% thus far in 2023 as of market close on Tuesday. Investors who are students of history will know the surge will likely continue. As far back as 1972, the first full year of trading for the NASDAQ. In the year following a market rebound, the tech-heavy index has generated gains of 19% on average, which suggests the current rebound will likely continue. The big story today in the meme world was GameStop. There's your 30-minute chart with that huge green candle. Got as high as $18.51 today and closed at $17.86, up 60 cents or 3.48%. AMC started out its week of trading with a huge crime candle to the downside on no news, thrusting the stock down as low as $6.47. I put a white arrow on the 5-minute chart so you could see it, and Uncle Frank's best fill for the day was $6.50, so there's my receipt. Then the stock reversed and followed GME up to a high of $6.84, finishing the day at $6.74, up 9 cents or 1.35%. Monday's off-exchange and dark pool volume was 9,787,000 shares, which was 56.15% of the day's total volume. Now, I don't know if you've noticed, but those pesky fails to deliver spikes are slowly making a comeback, proving once again that APE, its conversion and subsequent reverse split, only bought the bad actors on Wall Street some badly needed time. In my opinion, without APE and the RSC, this stock would have had a short squeeze already. And I'm pleased to report AMC is back on the Swaggy Stock Short Squeeze Sentiment List. It's a start, guys. It's better than not being on the list, right? At the time of this recording, max pain for AMC remains at 7 with a put-call ratio of 0.5835. According to Coin Codex AI, AMC should reach 734 over the next 5 days. According to our current AMC stock forecast, the value of AMC shares will rise by 8.84% and reach $7.34 per share by December 23rd. Not investment advice or advisor. Based on that last price of $6.74, let's look at the key turning points for AMC. To the downside, expect support at levels $6.53 and $6.31. To the upside, expect resistance at points $6.90, $7.05, and $7.27. Guys, if you even need more evidence that AMC is artificially being suppressed, I would ask you to consider this table from barchart.com. It depicts ETFs with significant positions in AMC. They are all up over the past 3 months unanimously, while AMC is down over 13%. That just doesn't line up with logic, considering we just came off the best third quarter in our 100-plus year history. I warned you guys this was coming in Sunday's big video, and it's already starting with this headline from tonight. The 2024 box office looks grim, but here's a best case scenario. You better prepare yourself for gloom and doom hit pieces about the first quarter of next year and the entire year itself for that matter. They are going to come like an avalanche. Just my opinion. Guys, I told you the Hedgies were in trouble and nothing has changed. In fact, I see things getting progressively worse for them. What we need is a white or black swan to touch ground, some unexpected event that will turn the prime brokers against their best customers, the hedge funds. If and when a systemic threat arises, that's when you'll see regulators and politicians line up against them as well. The final signal, in my opinion, will be a call to ban short selling on financials and banks. Regulators will step up controls on non-bank financial firms. The most ideal swan will be one that attacks the leverage chains of the hedgies, which are maxed out, forcing them or their prime brokers to a decision on elements of their portfolios like AMC. Stay tuned. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.